Good afternoon, everybody, and welcome to our webinar, Completions, Maximize Operational Performance and Optimize Spend in the New Reality. We have a couple of speakers today. Before I introduce them, just a couple of housekeeping things. We will be emailing a recording of the session after we're through. Generally, we send this out the day after, so keep an eye out for that in your email inbox. And we will have some time for questions at the end of the presentation. So should you see something here that you want a little bit more information about, feel free to type it into the GoToWebinar questions panel, and we'll get to those at the end. So with that, I'm going to introduce our two speakers today. So our first speaker is Akash Sharma. He's our senior analyst and consultant, and he actually works on our market intelligence team, providing petroleum engineering subject matter expertise for various product development and consulting efforts. His expertise lies in unconventional shale reservoirs with a focus on reservoir engineering, reserves estimation, production analysis, rate transient analysis, and data-driven modeling and analytics. And we also have Jonathan Godwin. He is a senior associate on our intelligence team. Jonathan is he covers oil field services and supply industries for Enverus. So with over a decade in the oil patch, he has spent time working in or on all the major unconventional plays across the country, mainly focused on completion, implementation, and optimization. So that being said, you guys have the right experts on this call to talk about optimizing completions performance. So with that, I'm going to hand it over to Jonathan, and he's going to kick us off.
Thank you so much, Susie. I appreciate the intro there. And Akash, if you will move over to the first slide, I'm just going to kick us off. Really, I want to talk through the macro picture and kind of set the stage for A, what's happening, and B, what we think will happen, and really what the implications are for that on the industry over the kind of near to midterm. And so, with our modeling and our macro teams, one of the things that I do and participate in really on a monthly basis is to forecast where we think completion activity is going, along with taking a good hard look at where it's been and where it is at currently. And so based off of our latest forecast and all the different pieces that are coming into it, we really see a slow and steady activity recovery over the next year. Really, after this, we've had this very tumultuous middle two quarters. The pace of completions in 4Q we expect to be, fairly flat. Those in the completion industry really over the last 2 years are all too familiar with the wild cyclicality that we've had where 1Q hits and everybody budgets reset and everybody wants to spend all their money up front in the beginning of the year, and then come 3Q, 4Q, we really start tapering off, and then things fall off a cliff in 4Q. But with the kind of unprecedented activity drop that we saw in March and April and May, what we've seen is that activity has recovered to where it's really kind of going to recover for the rest of the year, and we don't expect to have those same types of drops this fourth quarter that we've had for the past 2 years. In the fourth quarter, any kind of drop or slowdown will mainly be due to really winter seasonality. And then as we move into what next year is going to look like, really, our macro group sees prices kind of range bound at about $50 Brent. In fact, just today, OPEC Plus, agreed to kind of taper the taper. So they are going to ease the production adds that they had previously planned to start in January. So they're only going to be adding about 500,000 barrels per day back into the picture come January versus, I think that's a quarter of what they had planned. So it's a little bit of tweaking on the overall macro picture from the OPEC Plus community that we saw come in today out of Vienna. But that while that should be positive for price, I think we're going to have to wait and see what the longer term implications are. And then really kind of closer to home, on the macro side of the picture, operators are really talking about this idea of Shale 3.0 and a reasonable limited reinvestment of cash flow into production and production growth, where the focus is going to be free cash flow and free cash flow yield. Also ESG initiatives, right? So we've seen more of that discussion of both fiscal and environmental responsibility really being top of mind for the investment community. And the thing that's important is that those same metrics that are going to be applicable and top of mind for the investor community on the operational side of things are also going to be focused on the service sector as well. And so when we put that all together, really, so crude faces kind of headwinds next year, but we do see budgets resetting. And then with the sustained and current pace of completions and a healthy DUC inventory, we do believe that there is some impetus for completion activity to grow next year, although in a very, constrained manner.
Hey, Jonathan, a quick question from my side as we look at this chart. So first of all, to everyone listening, thanks, Jonathan, for this great overview. What we want to do as we move forward is establish this activity baseline as we talk about fiscal responsibility moving forward, right? So I think this gives a really good perspective. But one of the things that since I work more on the sides of the operations and the analytics side of things, one of the things that concerns me when I look at this chart is just the way all of this information is estimated, right? So we've been very well aware, and I'm sure everyone who's attending this is also very familiar with how much of a hassle it is to actually figure out what is out there. You know what I mean? Like the reporting practices vary so much from state to state, and when we look at an information like that in a high activity period, it's typically easier to get a good estimate because there's so much volume of activity and transactions happening that you can get a better understanding of the business really well, right? Whereas if you look at the last 6 months, the bottom fell out from under the activity graph, as is very clear from the analysis that you put together. So how were you able to sort of, let's say, assimilate or account for that lack of activity and the impact it has on the availability of good data to be able to project moving forward?
Yeah, and that's a great question and great framework for that, Akash. I really appreciate that because, traditionally what we've seen is that our completion data sources are lagged about 3 months or so before they really become reliable. But one of the things that's let us get to a very close to what I would call a near real-time picture of activity has been this product that we've pushed out called Activity Analytics. And if you go to the next slide, what I'm actually showing here is the culmination of really the output of the Activity Analytics package. And what we're doing inside of there is we're using a blend of proprietary data sources to actually get real-time detection of where pads have activity and specifically where they have completion activity. And so we're able to take things that, Enverus has always had really like the rig picture, right? And then by taking that and combining it with, satellite and telemetry data and some of these other data sources and putting it all together, we're able to really be very specific about where completion activity is taking place on a pad. And you're absolutely right. Like what that has done then is it has pulled our view forward, because if we were let's say that we were in May, right? If we were in May and we know from listening to data sources and people out there like what's happening, but we can't actually see that in the data yet because it wasn't coming through. Well, a tool like this actually let us see the bottom in completion activity take place. And you'll notice that what you see is that in about May, the middle of May, we saw active fracture pads or the estimated number of frac crews out there get down to about 50 crews running. And so we kind of bounced around, below that. But you see like February, right, that we were up around 250, and so a massive drop, very, very steep. The other part of that too, so what's interesting is, and what you see on this curve is on the white line there, that whitish gray line, that's actually our horizontal rig count. And then the stack is the number of active fracture pads that are happening on a daily basis. And then that dashed line is actually the ratio in between the two. And so what you get here is we're able to, in very real time, compare the number of frac crews that are out there to the number of horizontal drilling rigs that are out there, and look at that ratio. And what that ratio tells us is it really tells us how inventory is changing, right?
Yeah.
And so inventory becomes an important part of that picture. Go ahead.
Yeah. So my question, I guess, when I look at this is there's this peak of that rig to fleet, right, between April to, let's say, July. So would that be indicative of like that looks to me like a big duct building period. And it's interesting to me that the industry was out, drilling and building ducts in June, July. That is sort of the middle of the worst of the pandemic. So why do you think we saw that sort of why do we see that sort of shape in that data set?
Sure. Yeah. So the shape of that really is precipitated by, in my view, two things. Number one of which is that the rig contracts are generally a little more punitive in how fast they can be dropped and what happens when they're dropped versus the frac contracts. And so, I mentioned the fact that the frac crews dropped. The frac crews have dropped faster than the drilling rigs, and I also mentioned in that last slide really about the nature of the cyclicality that we've seen in the completion activity. And so that completion activity cyclicality was made possible by the fact, I think, in large part to the fact that the completion contracts didn't have a lot of the pricing power that the rig contracts did, because we were in such an oversupplied state for the pressure pumping market. And so they just didn't have the teeth that the rig contracts do. And so when we hit that kind of twin black swan event of both the pandemic and then OPEC deciding to get into a pricing war in late February, early March, what happened is that the completion crews dropped, and they dropped much faster because there weren't the contractual obligations that there were like with the rig contracts there. And so you heard of a lot of companies going on a quote unquote frac holiday, right? And particularly in the Bakken and the Permian and some of those plays where they said, you know what, we're going to maintain a rig, but we're not going to do any completions. And so that happened, not necessarily universally, but that happened in kind of the same mindset across a lot of the plays, minus the gas plays. The gas plays showed a lot more stability through this because they didn't, the gas prices weren't nearly as affected as the oil prices. So they've kind of been depressed and really, in our view, on their way back up for a little while.
Yeah, and now you can see that in like the Appalachia curve is not getting as skinny as some of the other oil-rich plays, for example.
Yeah, absolutely. Like Appalachia kind of took over the market share of where frac activity was taking place as the other plays dropped, very precipitously. Now, since then, June and July, completion activity bounced back, and the large majority of that bounce back was in the Permian Basin. Both the Delaware and the Midland Basins, right, have seen that frac activity bounce back. Most of the other plays have remained fairly repressed, but so the gas plays have lost market share a little bit. Yeah.
So based on what you've told me, the way I understand, and correct me if I'm wrong here, but completion, there was the rig punitive aspect, but it also seems to be that completion activity took a major hit because it was much more closer to production, and this loss of demand and the OPEC production war earlier in the year led to a significant impact on demand for that commodity. So we basically sort of stopped the closest stack to the end cycle, right? Having ducts doesn't impact the amount of production, so you can build those out. So if I'm correct there, first of all, how does this relate to sort of the forecast as you move forward, right? Because it almost seems to me that specific regions are growing differently, and there's so many more dials that are being tweaked. So how does this sort of correlate to, as you look forward, on this sort of regional activity?
Yeah, sure. So you're absolutely right that really like the impact of this is of the completion drops is the fact that they are closer to the production side of things. And when you can leave that money in the ground and not have that flush production in a shale well take place, where you get all of this kind of easy excess production at the beginning life of the well, if you aren't producing that into a low price environment, you come out better, on your NPV in the long run. And so it makes sense for most operators to leave that production, that potential production in the ground and wait for a better price environment if they can. Depending on how they have to sustain cash flow and things like that. But if you go to the next slide, the way that all of this translates then into the forecast is really to understand in real time what's happening with our inventory. And we delineate inventory in two major pieces. The first one is the natural inventory, which is, think of that as like the minimum work in place inventory. And so if you have X amount of rigs running, you aren't going to move a rig onto, or you aren't going to move a completion crew onto a well as soon as that rig is done drilling it, if it's on a 3 or 4 well pad. You're gonna build up several wells on a pad, you're gonna move that rig, and then the completion crew is gonna come in later. And so you have some delay discrepancy that's natural to the whole process of rigs and completion crews. And so there's always going to be 3 to 4 months of minimum work in process inventory in between the rigs that are out there and the completion crews that are running. And so that's the natural inventory of that gray piece, right? So it's just natural inventory buildup due to that. But then those colored bars are really the excess, what we call the true excess DUC inventory. And that's really your wells that you have in that inventory that you're able to pull from and really begin to draw down that are in excess of the number of rigs that are running. And this is where this idea of really your ability to use DUCs as a capital efficiency lever is coming from this group of wells in that colored band. And so, when we looked at that last chart, we saw that the discrepancy in between the rate of completions activity drop and really the timing of the completions activity drop preceding the drop in rigs led to, if you look at that red line and it going up to 1200, like that is, we were building DUCs through that time period at one of the fastest builds that we've ever seen. And then as we move into, go ahead.
Sorry, this is basically, if I'm correct, this also corresponds to the peak in the rigs to fleet ratio that we saw in the previous chart, yes. Right? I would assume it's in the same time period.
Yeah, exactly. Like those two things should align very, very closely to where we see that ratio changing and peaking and where we see this rate of builds and burns happening. And so those two peaks should overlap there. And so I guess what the point that I'm trying to get here is that we did build up our excess DUC inventory very, very quickly. However, we have transitioned into a DUC burning regime. We're now burning about 200 wells or so per month. Starting in July, we started to burn wells out of the DUC inventory, and even though we built up this very, very large excess DUC inventory, and our natural inventory is low due to the number of rigs that are running, right? It's not going to last forever, and so while the DUC inventory can sustain capital efficiency for a time, it's not the long-term solution, right? And that. And what I'm trying to get at here is that we do have this, it is a lever, it will help in 2021, but it's not necessarily the long-term answer. And as we move into this new regime and what's going to happen next year, and if you'll go to the next slide real quick, Akash, I really wanted to come back to this because this is really kind of the linchpin argument for the lower 48 next year, is that we've got this story of constrained activity growth from current levels, right? Like the DUCs do help They will help improve capital efficiency, but operators are going to continue to be pressured to show good capital efficiency, and there's going to be increased scrutiny on that. And investors aren't stupid. They do know that the DUC inventory will last for a while, but it's going to run out at some point in time. And so when that runs out, what are the different levers that they can pull for how they approach cost optimization, and then what tools exist for them to approach that data in really a rigorous, analytical, but consumable format?
Yeah, no, absolutely. And I think that's a great point, Jonathan. When we look at, especially with the sort of volatility that we've seen in the market, as you pointed out, the last couple of years, and the complications that come with it, not just from a standpoint of on the BD or the market development side for a lot of these operators, but also from a standpoint of consuming raw materials that go into making these trends happen, right? The purchasing aspect of it, the spend aspect of this has also become exceedingly important for the customer base that I have had the opportunity to work with, and also increasingly so become part of the day-to-day vernacular across the industry. And that goes back to exactly what you're saying, is that fiscal responsibility and operating within your means is extremely important. But at the same time, shale particularly is a fast declining asset from a production rate standpoint. So if I have to maintain steady production, I also have to maintain a healthy process of, a healthy process of continued development and, activity. So it's like you need to be a very efficient, but also really powerful engine somehow at the same time.
Yes.
And so to work with that, what I wanted to sort of introduce to everyone here is the idea on how we as Enverus approach the cost perspective here. This all started through the process of an acquisition we made a couple of years ago that allowed us to really understand information on a transactional basis going across in the industry. And what we were able to leverage is that information, combining that with sort of our analytics capabilities in-house to develop a suite of products, but key amongst them for this discussion has been sort of a market indices, right? Market indices are commonplace. I know there are a bunch of, I think the Federal Reserve provides a few of them for all these different industry sub-industries, and you can start to see what the market is doing, how it's performing. But there was a lot of concerns around how that data is sourced. It's survey-based. It's a complicated formula and how we do it. So we wanted to try and see if we can approach it from a different perspective and lend a different perspective to enable a lot of these teams that have to make decisions really quickly, right? We went from having, if I remember the numbers on your chart correctly, Jonathan, from about 200, 250 frac crew pads in like February, March to about 50 in May, right? That's like almost 70% of the market gone in like a quarter. And so the supply chain needs, the planning needs, the perspective on how I manage the remaining activity and the remaining budget have to change completely, right? And it varies so much basin by basin that it can have a huge impact on how you approach this. And so to start off with that point, because as you mentioned, there's a big change in the way Permian and, for example, Appalachia have progressed even through this pandemic and the OPEC cycle and everything. And so if we start off with the first view here, what we're trying to look at is indexes that we put together, and we've created very, very specific indexes. We've put together indexes for individual mesh sizes for particular basins or specific individual chemicals, because a lot of these things are dependent on so many different variables, right? 100 mesh, it has a very different development and demand supply life cycle as compared to 40 by 70 Northern White, right? If we look at, for example, chemicals, Crosslinkers is based out of Guar, which is sourced from farmlands in India, which is very different from how you would manufacture polyacrylamide for friction reducers. So looking at the granular perspective really makes a difference. But if you look at this, and Jonathan, I'm going to ask you to provide some more commentary here, but being the proppant expert. But if you look at these two things, what's really interesting to me is first of all, the dotted line in both cases is the actual index, but we also provide sort of a zone of uncertainty. And it's not necessarily a confidence interval or uncertainty. It provides a range where a majority of that transactional information would reside in, right? So what, for example, what the US chart tells me is that nationally speaking, once we weight it based on activity and pricing variations, the 100 mesh market seems to have consolidated significantly and is skewed very heavily towards the lower end of the pricing range, right? There are still transactions happening on the upper side of it. Again, that's a regional supply demand issue there. But, it tells me that nationally, when you look at the overall numbers, it is very tightly hugging the bottom side of the market. But the story on the Permian specific is really different, right? And like when you look at that chart, when you look at Permian, again, we're still looking for a floor there, but being a very sort of stable but skinnier distribution of data. How does this correlate to sort of your analysis on the activity and completion design in the basin?
Yeah. So thanks for that, Akash. I think that so there's a couple things that are happening here, and it is really, really interesting when you put it in context of, and I think the key thing is what you said was that this is activity weighted, right? So the US index kind of seeking towards the bottom really puts it into perspective of the fact that the Permian has played such a huge role over the last, really 2 years. And then really the introduction of local in-basin sand contributing even more so, specifically in the Permian where that in-basin sand has blown up. That market has grown, 1,000% over the last 3 years. And it's been really, really interesting to watch what happens to proppant prices. And then also the fact that you are pulling that whole index down because of the fact that proppant prices are so cheap in the Permian. Now, it really is interesting, like you said, like there's a large variance of price mainly due to regional aspects in places like Appalachia where you don't have the same access to in-basin sand, and you're still railing a lot of that northern white sand, which does carry a higher cost premium, a large part of that due to the transportation there. And then on the Permian side of things, where we see just this flood of in-basin sand come in, we've seen this just steady downward trend ever since 2018 of that 100 mesh price index. And really that goes to two things is A, that influx of in-basin sand, but also the preponderance and the tendency to use 100 mesh sand. And I think too, really some of the widening up of the mesh distribution of what is 100 mesh. Most of the time people call it 4170, but we've seen really those kind of cuts due to mine efficiency be a little bit looser. And people being willing to pump, I guess, a little bit broader spectrum sand as 100 mesh too. So, a couple different things at play there. I think it is really interesting too to note that, like the U.S. index getting bumped at May of 2019, right, or in that time frame. I talked about the cyclicality that's happened in the completion activity market, and what this shows us is that we've seen that same cyclicality get introduced into the proppant markets, where everybody tries to front end load capital, spend all their dollars up front in the year, and lo and behold, we have a crunch on sand as more people are trying to pump more proppant at the same time. And so that brings in, tighter prices, and then of course, plants ramp up, and we see that impetus for slightly higher prices fade away as well.
No, absolutely. And I think one of the things that you mentioned was really interesting, and thanks for giving me a great segue into the next slide. But one of the reasons that 100 mesh became so popular is because we sort of started transitioning away from cross-linked and linear gel-heavy fracs to, more and more slick water, right? And so we saw friction reducer become such a big component of completion design. And so as we looked at another example as we walked through this, what in this analysis that we did was we combined actually the price index that we put together, again, for very specific friction reducers in the Permian Basin, We combine that with the analysis that you all had put out, Jonathan, about the activity, right? So we can sort of correlate completion activity in a particular region, since the index is already driven partly by that. Combine that with the sort of changes or sort of trends in prices that we saw when the the existing behavior in let me rephrase that. So what we were able to do is correlate the changes in prices that come out as a result of suddenly changing activity or slowly changing activity, right? So once we establish that correlation, that if we had X number of fleets in such an amount of time, what is the potential impact on pricing of a material, right? It also goes to the point that you just mentioned, that what we saw in the prop and the May bump, right? People are trying to front load a lot of the spending, make sure that their planning is right. A lot of RFQs are due early in the year. We also see that saw that like in 2018 when the slickwater craze originally began, and that's why we see that price, in the initial bumps, is because people were trying to get into longer term contracts. I've been in multiple consulting engagements, so one of the things that clients wanted us to figure out was, do you think we're going to run out of polyacrylamide or friction reducer, right? That if you think about the rate at which we went from pumping polyacrylamide in 16, 17 to 18, like that's not an invalid concern, right?
No.
And so I think that starts to make a big impact, and that allows us to sort of look forward in the next 8 to 12 months and try to correlate how particular chemical prices would vary based on this, right? And so before I engage you on this, I think one thing that I also wanted to highlight was just how different, again, I might be repeating myself here, but like how different regional markets are, which I think makes all of this so much more interesting, right? So the three lines that I'm showing there, Jonathan, the orange, blue, and red, are activity, volume, and transactional dollar weighted indexes that we put together for the entirety of the United States, right? And so while the general market is similar, and we saw a bigger bump, let's say in 2018, in early 2018, as you see in the prices as compared to national numbers, because similar to Propend, Permian was driving so much of that activity, that whole FR 100 mesh craze came out of this basin, right? But what we also see is that it's such a tighter spread, nationally speaking, right? Which I think speaks to the variance of and how different the market is. So when you look at something like this and compare sort of the U.S. distribution versus the Permian distribution on a key commodity like this, what are your thoughts on as you look at this analysis?
Well, a couple things. I think that if we were to it seems like at first glance it may be a little bit counterintuitive that the Permian region, which would command maybe the most pricing power, seems to have a higher discrepancy in price of FR paid. But I think when you link that back to activity and where the majority of activity is taking place, like it makes a lot more sense, right?
Yeah.
And so when you begin to put that in perspective of the fact that the FR market in the Permian is much larger than in other basins, and what they need and what they were demanding at that time, really is pretty interesting. I think you've had some interesting commentary there.
Yeah, no, absolutely. And it's also like, to your point, it's relative scaling, right? So the national market is definitely bigger than the Permian market, right? But the Permian market, for the size and activity it commands, is much larger than any other basin's relative market size. And we've had so many conversations with operators where a lot of and we've seen, if you look at the gray zone carefully, it's getting skinnier as we move from left to right, right? So there is focus, there is some consolidation there. But the suppliers know that they can command a better price. The operators know that this is the key component, which I think we've gone from about 12% or so in 2016 to almost 30 to 35% of a frac job is friction reducer, right? So I think what that allows to do, there's just more power on the sell side. And I think additionally, the ramp up speed was so much focused on, drilling and completing the next well. The pace was so fast that many times, putting your head down and focusing on sort of what does this mean from a cost perspective can get lost. And so with that, what I wanted to show you is a quick example on how, we've sort of approached this problem. And so one example that we're doing here is sort of starting to do some benchmarking, right? So benchmarking a particular operator's index relative to the market, give them some perspective. The index, that is our national profit index. The operator index is made up. It's just, I'm not disclosing, there's no actual operators data here. It's just a random curve. We randomize those curves. But, I would not be surprised if there are multiple operators with a similar curve out there, right? Mm-hmm. A lot of operators took initiatives to find cost savings opportunities as we got past that initial bump as you spoke about, right? 2018 and then 2019. Both of those are reflected in the operator's curve as well, but they're sort of slightly offset because, of course, individual trends are different. But I think what was really interesting to me when I look at this is, what does it mean from a cost saving perspective, right? There is so much that you can end up leaving on the table because of how and when certain initiatives are kicked off. So for this perspective, I looked at this distribution where they were, technically over the market or beating the market, but basically there was a discrepancy between the way the market was trending and where this operator was trending. And you combine that with, I took completion activity trends for 3 operators of varied sizes, and they have like differences in the way their schedule works, right? Some of them picked up activity in 2019, some of them picked up more activity in 2018, and others have been relatively flat. And so what we find is that, in all 3 cases, even after the operator spend, if I go back on the last slide, the last almost, I'd say roughly about 10, 11 months under beating the market, they still end up cumulatively overspending because they haven't recovered that delta, right? Because there was so much activity in early 2018 that overpayment is sort of, it keeps on sort of staying there. It sort of stays there when you look at the cumulative perspective. And now, while I know that, every year budgets are different, nobody's looking at 2018 spending to, account for 2019 spending. I think what this tells us, more importantly, is why being proactive is important, right?
Yes,
making these
absolutely.
decisions sooner rather than later is critically important because of the amount of cost savings that are potentially here.
Well, yeah, I mean, to put that in perspective, right? Like this would be for a small operator, like, 27 million would be, call it, nearly 5 wells worth of, worth of completions or total well cost, right? So you are hampering your ability when we put this in perspective of really the capital efficiency and the cost optimization. Like you really, it comes down to like timing is everything. I think this like very clearly points out that timing is everything. Like when you spend that money and how far or under you are of the benchmark, and puts you in a competitive position next to your peers. So timing is everything, how you spend it, when you spend it, and then really like it allows you to go back and for the future when we talk about how important the impetus for cost efficiency is going to be and how much focus it's going to be there, like this is going to become super, super critical. I think it begins to draw everything in perspective. And are you beating the market is, I think, going to be a standard question that you have to ask on almost every aspect. Like what region you're in, what chemical or what material you're dealing with, like all of those things, like putting it in comparison, it brings it home to how do you approach this idea of fiscal responsibility.
No, absolutely. And I think like one of the biggest challenges that like I have heard as we interact and work with these customers on this is there are a lot of moving parts in these processes, right? Like I'm not sourcing one individual chemical at a time, right? Now, don't get me wrong. I know for a fact that there are operators who do get into that level of granularity and minutiae, and I'm sure the people on the call are familiar with them as well. But others are just wanting to get like an upside perspective, like just an overview perspective, and also sort of combine a lot of these variables. So for that, what we also work on and like provide is looking at the entirety of the market. So as an example, let's look at the left side first. We showed you the Permian index, right? But the friction reducer index is not the entirety of the Permian Basin's cost, right? It is a big chunk. It's an increasingly bigger chunk, but there are also other variables that make a big impact, right? And it's important for us to understand these things and how they correlate to overall frac prices, because that can also help us understand what the expected forecast is, right? So as an example, and I'm not saying there's anything like this that I'm aware of that's out there, but let's say a biocide, that is being used right now. As you mentioned, Jonathan, that there are more and more ESG responsibilities that are coming out. Just let's assume that a regulatory policy comes out that causes an additional tariff on a particular chemical used in a biocide, right? So that biocide's price increases by, let's say, 10%. Now, it's very important for me, if I'm planning and budgeting for X number of completions next year, to figure out what that would mean, from sourcing biocide, who can I still source that biocide from, and all that things. But also, what does that mean for my frac cost, right? If my biocide went up 10%, what does that mean for my frac cost in different regions? Because the regulations can again be different, right? So I think combining that information is really important. And then on the other side, I want to call back to a point that you made a few slides ago about the difference between Appalachia and Permian costs, right? And especially in the proppant side. And so the way proppant is shipped and like transported across the Permian is so different from the Appalachia that if I want to understand the overall market, just looking at the commodity price is just one side of the story, right? So you have to understand sort of the logistics aspect of it. And because even though a few years ago, it was a very small portion of the overall cost, as proppant has gotten cheaper and cheaper, the logistics part has become more and more critical in creating the most optimized solution that you can.
Yeah, absolutely. Absolutely. I mean, when you're talking, proppant prices down where they're at, like the proppant hauling and logistics portion of that can make up to 20% of the cost or more. And so it becomes increasingly important, right, to figure out like where you're sourcing your proppant from regionally, and can they get it to you inside of a certain radius, on trucking. And for the purposes of this talk and really in these indices, right, it helps you to gauge where you are at inside of the overall market, right? So you might be getting your proppant price at a little bit lower cost, but if you are paying more for hauling and it's 20% of the total cost, how much is that impacting the whole thing? And so it really takes something like this where you're able to put the different components of the cost together in order to really get a full and proper gauge of where your spend is in relation to others in that market.
No, absolutely. And I think for me, one thing that really ties all of these things together is just how, the trends that we saw in your part of the presentation about changing activity and changing performance correlate to how different pricing strategies have been adopted, right? And it really allows us to, as we look forward to, Shale 3.0, more fiscally responsible operations, how different components, proactive supply chain initiatives, more integration work with operations, engineering, SCM, procurement teams, and then combining the information that we know both about fundamentals, market activity, as well as, maybe a little bit more specific price behaviors of individual commodities can provide sort of a holistic strategy for operators moving forward. And so with that, we'll open the floor for questions. If you guys have any questions, please add it to the Q&A section. And we'd be happy to answer them.
Great job, guys.
Sorry, go ahead, Susie.
We do have a question here. So could you maybe provide some situations that you guys have been in where you've used these market indices with different operators, kind of, in your discussions?
Mm-hmm. Yeah, sure. So, I mean, given that it is, transactional information and proprietary data, I won't be able to release any names or anything of that sort. But I think there are a couple of examples where I think that it was interesting what we were able to do working on specific sort of case studies with operators. So I think one example that sort of comes to mind, first and foremost is we were working with a operator, a multi-basin operator, and they had several contracts on their complex services piece, and they knew that they believed that they were sort of overpaying X percentage because of the quality of service and the quality of just the relationship there and the faith they had in the supplier, which is all well and good, right? I think that's a good way to build your business as long as it's within the budget, and if you can trust the supplier. I think that's a healthy relationship with there. But I think the problem that came out was that they were not aware of the fluctuations that were happening in the overall market, right? So when they became aware of that, it allowed them to get a better perspective on, as they negotiate moving forward, on to be more sort of dynamic in their contract structures and pricing. And I think that's really important because, as we saw, some of these categories, their pricing falls off like 60% over multiple years. So even if you have a long-standing relationship with the supplier, having a better understanding of the market and having a more data-driven conversation around it can really help maximize your cost savings in the area.
Very good. Basically putting you in a stronger negotiation position with your suppliers.
Absolutely. Yeah, and I think one of the things that we hear all the time also is that there is mandates that come even on the operator side that, hey, we need a 30% discount across the board. It comes from there are specific IRR numbers that companies are trying to hit. It's completely viable, but the problem is that not every supplier can give you that percentage of a discount, right? As we saw in Jonathan's part of the discussion, completion companies are going to recover faster than rigs, right? So their cash flow is going to be generated sooner than some other companies. So depending on the company that you're working with, it's very important to be aware on how their market is doing, so that do they have the fiscal strength to offer discounts? Because you might be just negotiating and running up on a wall. Your time might be better suited going and working with a supplier whose industry is doing better, and they can potentially afford to give you that sort of discount. I think that's something, Jonathan, that you guys also built out in your analysis, I think a couple of months ago, right? Looking at different segments.
Yeah, it was really it's really interesting and informative when you begin to put all these different pieces in context of the total health of the market. And certain vendors and supplier groups out there are definitely more healthy than others. And so, it's all well and good to tell your investor community that, oh, well, we need a 30% price cut. But obtaining that from, say, like a pressure pumper who's already operating on razor thin margins is probably not going to be viable. And so you have to consider what the long-term impacts are to both the market itself and your vendors, right? And also for the vendors themselves, understanding that say like the bands on your price index, that the cost variance is very low for a particular group, really helps make the argument that there's not a lot of room to give inside of that band, right? Like, where else can we find cost cuts? And have the confidence to know that you can challenge an operator on that side of things. So I think these work both ways and are very important for both groups of people.
No, absolutely. It's always better to know than to not know.
So can you speak to maybe how these market indices might help an operator in having conversations with their investors?
Yeah, absolutely. So I think that's one of the things that we work a lot of times with, especially on our RS side, with the board presentations and those sort of more corporate sort of analysis. I think every operator definitely wants to be in the top quartile of their cost savings operation, right? I think this is a conversation I've had with many operators, especially over the last few months, as we get into planning 2021 phase. Everyone wants to be in the top quartile. Well, if everyone is in the top quartile, then that's not the top quartile anymore, right? So I think there has to be realization that there is always going to be a distribution. And it's important for different operators as they set their priorities to have varying expectations across their portfolio. We've worked with operators who identify that the next, let's say, X number of months are going to be more LOE focused. So for the time being, depending on how their assets have performed over the last 6 months, they want to focus on these 1 or 2 categories. And what this allows them to do is, as Jonathan mentioned, go back to their shareholders, go back to their board, and show with evidence that they are being fiscally responsible. They are part of the Shale 3.0 community of companies, and being sort of the market leader in working within your cash flow and being very, very smart about it by making sure that they're trying to maximize their efforts and cost savings in areas that matter the most. Right? If I'm going to be just producing legacy gas wells for the next 6 months, let's make sure my compression is on point. Right? That's the big ticket item. Right? And so I think that's the sort of things. It's investor confidence, it's shareholder confidence, and just having a data-driven proof to show how you're performing.
Yeah, Akash, I would just add too that I think that one of the really interesting things, and to further that point, is like let's say that you are overspending on a category. For example, let's throw surfactant into the mix, right? And let's say that you believe that it works, and what it does is it tells you, okay, I'm over the mark here. They're going to ask a question about that, and I better have a justification for why I'm putting money into this category, that it relates back to the whole idea of capital efficiency, and whether that is MPV or what have you, whatever the metric is that you're going to be judged by is, does that hold up under the scrutiny of the question, why am I spending more here than the market average?
Absolutely. And that's especially true as we go on completions. How many generations of completions have been in the last 3 years, right? And so as we keep on iterating on these completion designs, you're going to end up spending more on one thing or the other. But the ability to tie it all back together again to your NPV, to your net productivity and things like that is really important, especially when you go and talk to your board or to your shareholders.
Yep.
Awesome, guys. Well, we are almost to the top of the hour, or the bottom of the hour, I guess. So just in closing, wanted to let you guys know, if you guys have any questions or want to learn a little bit more detail about the market indices that they were showing here, we'd be happy to show you and talk you through how that works. If you'd like to set up some time, you can always email us at businessdevelopment@enverus.com. And with that, as I said, we will be sending this recording out to all attendees. So thank you so much for joining us today, and stay safe and stay healthy until we talk to you again. Thanks for joining. Bye.
Thanks, Jonathan. Thank you, everyone.